Chapter 6: Risk and Return. The topics in this chapter include basic return and risk concepts, stand-alone risk, portfolio or market risk, risk and return, campaign and security market line, market equilibrium, and market efficiency. What are investment returns? Investment returns measure the financial result of an investment. Returns can be expressed in dollar terms or percentage terms. What is investment risk? Investment risk is exposure to the chance of earnings less than expected. The greater the chance of a return far below the expected return, the greater the risk. Here is the scenarios and returns for a 10-year zero-coupon T Treasury bond over the next year. You can see for each scenarios, they give the probabilities and the returns. Calculate the expected rate of return on the bond for the next year. It will be the sum of the probability times the corresponding returns. Standard-alone risk, standard deviation. Standard-alone risk is the risk of each asset held by itself. Standard deviation measures the dispersion of possible outcomes. We can use the following formula to calculate the variance and the standard deviation for discrete probabilities. Standard deviation of the bond's return during the next year will be calculated as follows. Portfolio returns. The percentage of a portfolio's value that is invested in stock I is denoted by the weight WI. With N stocks in the portfolio, its return each year will be calculated as follows. Correlation coefficient. The correlation coefficient measures the tendency of two variables to move together. We can estimate the correlation coefficient using the following formula. Two stock portfolios. Two stocks can be combined to form a riskless portfolio when the correlation is -1. When the correlation is +1, risk is not reduced. When the correlation is between -1 and +1, risk is reduced but not eliminated. Adding stocks to a portfolio. What would happen to the risk of an average one-stock portfolio as more randomly selected stocks were added? The standard deviation of the portfolio would decrease because the added stocks would not be perfectly correlated. Risk and the number of stocks in portfolios. In the following picture, we can see as we add more stocks in the portfolio, the risk will significantly reduce. However, we cannot reduce the market risk. We can only reduce the company-specific risk. Stand-alone risk equal to market risk plus diversifiable risk. Market risk is that part of a security's stand-alone risk that cannot be eliminated by diversification. Firm-specific or diversifiable risk is that part of a security's stand-alone risk that can be eliminated by diversification. Market risk due to an individual stock. How do you measure the amount of market risk that an individual stock brings to a well-diversified portfolio? William Sharpe developed the Capital Asset Pricing Model, or CAPM, to answer this question. Required return and risk, the CAPM. The CAPM defines the risk premium for stock I as the following equation. The security market line relating the risk and the required return. The security market line puts the pieces together, showing how to determine the return required for bearing the stock's risk in the following formula. Efficient market hypothesis, EMH. The EMH asserts that when new information arrives, prices move to the new equilibrium price very quickly. Weak form market efficiency. Current price already reflects all the information contained in past prices, so you cannot earn excess returns with strategies based on past prices. Example strategies include invest in stock that have declined below their previous 52-week low. This is a type of technical analysis. Same as strong form efficiency. Current prices already reflect all publicly available information, so you cannot earn excess returns with strategies based on information from financial statements or other public sources. This is a type of fundamental analysis. Strong form efficiency. All information, even inside information, is embedded in stock prices, so you cannot earn excess return ever. This is not true. Excess returns can be gained by trading on the basis of insider information. Insider trading is illegal. Go to jail now.